In the semiconductor industry, there is a constant battle between performance and cost. On one side, you have silicon cheap, scalable, and abundant. On the other side, you have compound semiconductors materials like indium phosphide or gallium arsenide, which are incredibly powerful for sensing and communications, but historically expensive and difficult to manufacture. For decades, the Holy Grail has been to merge these two worlds, to combine the high performance of compound materials with the mass production economics of silicon. Today, we're going to talk about a company that claims to have cracked this code. A company that is building the eyes for the next generation of autonomous machines and mobile devices. That company is Aluma, ticker symbol ALMU. We have analyzed their entire public financial history, from the developmental years of 2021 through 2025, and most importantly, we have dissected their latest quarterly filing for the first quarter of fiscal year 2026, which ended in September 2025. This is a story of deep technology, high risk, and the race against the cash burn clock. Let's start by understanding what Aluma actually builds. They are not a traditional chip maker. They specialize in high-performance sensors, specifically LiDAR and optical sensing. Their proprietary technology allows them to grow high-performance compound semiconductor materials directly on large, standard silicon wafers up to 12 inches. Why does this matter? Because the world is hungry for sensors. Autonomous cars need to see long distances. Smartphones need to scan faces and environments. Data centers need to move information faster with light. Aluma's technology promises to make these sensors smaller, cheaper, and more scalable than ever before. But great technology does not always make a great stock immediately. Let us look at the financial reality through the lens of their annual reports from 2021 to 2025. These years represent the R&D phase. The financial statements show a classic pattern of a pre-revenue deep tech company. Millions of dollars spent on research and development. Net losses widening year after year. The company was building its intellectual property portfolio and setting up its manufacturing processes. For an investor during this period, patience wasn't just a virtue. It was a requirement. Now, let's fast forward to the present. We have the 10Q report for the first quarter of fiscal year 2026 in front of us. What is the data telling us right now? The most critical number for Aluma is not yet profit, but commercial traction and liquidity. In the latest quarter, we see that the company is still in the early stages of revenue generation. They are moving from purely developing technology to sampling products with potential customers. The transition from a science project to a business is the most dangerous phase for any company. This is often called the Valley of Death. Looking at the balance sheet in the Q1 2026 report, cash management is the headline story. The company operates with a lean structure, but developing semiconductors is capital intensive. The report highlights their ongoing need to raise capital to fund operations. As an investor, this is a double-edged sword. On one hand, raising capital validates the technology if big partners buy in. On the other hand, it often leads to dilution for existing shareholders. However, there are green shoots of hope in the 2025 and 2026 filings. The company has been pivoting towards co-packaged optics and mobile sensing. They are targeting high-volume markets. Unlike high-end automotive LiDAR, which takes years to adopt, mobile and data center markets move faster. The filings suggest that Aluma is positioning itself to be a supply chain partner for Tier 1 technology companies. Let's talk about the moat. Aluma's advantage lies in its manufacturing process. By using standard silicon foundries to process exotic materials, they avoid the need to build their own billion-dollar factories. This Fabless or Asset-Lite model is crucial. It means that if they get a design win, if a major smartphone maker decides to use their sensor, they can scale production rapidly without massive capital expenditure. But we must address the risks. The 10K reports consistently list going concern risks. This is standard legalese for we need more money to survive. The semiconductor cycle is currently volatile. Investors in ALMU are betting on a binary outcome. Either Aluma secures a major commercial contract that validates their platform, sending the stock significantly higher, or they struggle to bridge the gap between R&D and revenue, leading to further distress. So, what is the investment thesis for 2026? Aluma is a call option on the future of sensing. You are not buying this stock for today's earnings. You are buying it for the potential that their 3V on silicon technology becomes the industry standard for LiDAR and optical interconnects. The bust of the 2023 to 2024 tech correction has compressed valuations. Aluma is now trading on the potential of its IP and its ability to execute over the next 12 to 24 months. If you believe that the future involves more cameras, more lasers, and more sensing in everyday devices, Aluma offers a unique, albeit high-risk, entry point into that trend. The technology is verified. The challenge now is purely commercial execution. As we watch the fiscal year 2026 unfold, keep your eyes on two things: announcements of joint development agreements with major tech firms and the cash runway. These will be the catalysts that determine if Aluma becomes a unicorn or a cautionary tale.